Okay, let's start. Thanks to all of you for coming. Those who are here at the table, this is a new setting compared to the way we've done it in the past, and also most welcome to those who are listening in or watching wherever you happen to be in the world. Those of us here today is Marianne Lassén, who's head of the Monetary Policy Department, and myself, Stefan Ingves. And we're going to go through the monetary policy update the way we presented it earlier today. But in addition to that, I mean, we're ready, of course, to comment and discuss whatever issues that you would like to raise. So the main conclusion this time on our side was to say that we see some positive signs in the Swedish economy, and that's basically another way of saying that the large drop in growth, as far as we can judge, is behind us. And now when we look into the future, 2012 is going to be not a very good year, but still positive growth, and then eventually we'll get back to something which is more normal, something that we are more used to recognizing. And at the same time, this happens against the backdrop of fairly low inflation, but inflation will pick up over time, pretty much the way one would expect when we're going through the cycle. And then all in all, given that the starting point is a low policy rate in the first place, the conclusion was to keep the policy rate at 150, to keep it on hold. And then given that when we go through the cycle, eventually inflation will pick up and we'll slowly start raising the rate towards the end of next year. But given the type of economy where we conduct monetary policy in a small open economy, we still, whatever we do is against the background of what's going on in the rest of the world. And here, as all of us know, financial markets stay fragile. It's important here, though, to point out, though, that we're really talking about financial markets in Europe. I mean, if you talk about, the financial sector in a kind of a global sense, it's not that issue that we're talking about. And this is just this graph. If you look at, for example, Spain and Italy, is another way of reflecting on the main scenario we have in the report, which is basically assuming that eventually the issues that need to be dealt with in various parts of Europe also eventually will be dealt with one way or the other. But having said that, this is not going to happen in a uniform way. So you'll find differences between countries, and in some instances there will be steps forward and steps also backward. But eventually, over time, these issues will be settled in such a way that Europe returns to more normal times as well in Southern Europe, and will return to growth. But all in all, if you look at our analysis here, the red graph, weak growth, they will stay for us in the euro area for a while to come. Particularly 2012 will be a difficult year, but then growth will slowly pick up. Looking at the U.S., growth is also picking up in the U.S. There are a number of labor market issues in the U.S., but in terms of the growth numbers, as far as we can judge, are on the way up, and that's of course helpful both in the U.S. but also in the rest of the world. And then in order to get to the global growth number, one could add another graph which is way above the yellow one, showing what's going on in China, India, and other fast-growing, very populous countries. And that takes us to global growth around 4%, which is basically beneficial for the Swedish economy, given that gradually our exports are becoming more and more diverse, both in terms of what we produce and to different parts of the world. And here, this is just another way of illustrating that, given that we had the large drop in exports last year, that immediately affected GDP, particularly GDP in the last quarter last year. But as far as we can judge, exports will bounce back, and when that happens, and when increase in exports normalizes over time, then also that will affect the growth numbers, and that will affect the growth numbers positively. And in addition to that, which is not included in this graph, that also means that we will return to a situation with a large current account surplus, but a current account surplus of a magnitude which is roughly the same as we've seen in the past. We've also seen some improvements at the start of this year. If you look at, let's say, for example, the retail trade index, which we have on here, retail trade continues gradually up. And if you look at the export of goods, you can see here that there is also a slight increase in the past few months, and we expect, despite the last number there, we expect this to continue in a most favorable way, actually, going forward over the years to come. We also have some positive signs when it comes to various other economic indicators here, as you can see on this graph. When it comes to overall economic tendency, it's a marked increase, and at least if we were just only to look at this graph, it says that we would be back to sort of normal times. That's not quite the case, but at the same time, clearly, this is a strong positive sign that's showing that the economy is moving ahead and is likely to continue to move ahead over the years to come. On the other hand, the labor market will deteriorate slightly, which is not all that surprising, given that the growth is way below average in 2012. But then when we get back to more normal conditions, then we expect unemployment to gradually continue decreasing over the years to come. But also, as you can see here, when you look at this graph, and if you were to compare it with what we said in February, there are very, very small differences compared to our way of looking at things a couple of months ago. And this, all in all, then, if you add things up, it shows that inflation is low. Inflation is low because the krona has appreciated in the past. We've had good increases in productivity, and we have also had fairly low wage increases. Some of those things will change over time, and particularly when aggregate demand picks up, being it from the outside or domestically, it doesn't really matter so much. That increases inflation pressures gradually, and then will move up when it comes to CPIF towards 2%, and then CPI, given that we have interest rate increases included in the CPI, will move up towards 3%. Also, it's a quite unusual period in the sense that it's not that often that CPI and CPIF actually coincide. And if in the past they have only coincided for a short while, but this period they seem to coincide a little bit longer. But that's more a technicality that has nothing to do with economic developments. And all in all, then, adding things up in order to achieve this, as far as we can judge, the repo rate will remain low at 150 sometime towards the end of next year, and then the repo rate will gradually move upwards over time. And as I alluded to earlier, this is pretty much the same type of analysis compared to what we said in February. But as always, this is a forecast. It's not a promise, and things can happen. And if that were to be the case, for example, if things improve much faster than we expect because households get more confident or the corporate sector improves, then of course that will increase demand, and that will push up prices a bit more, and that would lead to interest rate hikes sooner compared to the interest rate path. While on the other hand, if something were to happen in Europe, which is not foreseen at all, and in a very negative sense, that's likely to affect the whole region, and that then would, of course, most likely push push interest rate hikes way into the future, and that wouldn't, in that scenario at all, include the policy rate going in the other direction, us lowering the rate. But nonetheless, one way or the other, the dotted line, that's our best scenario, our main scenario, and that's what we think is most likely will happen. But if the world were to change, then we'll have to change as well. Now, Marianne, a few more comments on some of the more technical aspects of this.
Okay, so as usual, a host of new issues arise when we work with our forecasts. And one such new issue this time was what to do with the revised data regarding hours worked. And as you all know, Statistics Sweden revised the historical series of hours worked in conjunction with the release of the Q4 figures of the national accounts. And for us, the question was how should this be interpreted? And I'd like to explain now how this has affected our view of resource utilization. I'd like to go through three graphs, including this one, and your comments are most welcome if you have any. So most of you, I think, have seen this graph before. With the new data, the level of hours worked is actually 1.8 percentage points higher than where we thought we were before. And how, as a first step, how has this affected our hours gap? Well, the bottom line is that we've interpreted half of this revision as reflecting a higher trend level of hours worked. Let me explain this a little bit. Since employment wasn't revised, the higher hours worked also implied a higher historical level of average hours worked. And that gave us, we interpreted this as evidence of a higher trend level of average hours worked and of hours worked. So we've revised the trend level there. And the outcome of that then is that we have a new hours gap. The old gap is the blue line, and you can see that the new gap, the red line, is substantially is less negative. Half of it comes from a new view of the trend level, and as I explained. In fact, if we hadn't changed potential hours at all, the gap would have been positive. But we sort of split it between the gap and the trend. You can also see that going forward, the growth rate in hours has been revised down a bit. You can see that from the slope of the curves, and the reason for this is that essentially that with a lower gap to begin with, there's less catching up to do. So the growth rate in hours work going forward is a bit slower. But the hours worked gap is smaller. The next step then is to ask, what does this imply for the GDP gap? And this is the graph showing the old GDP gap, which is the blue line, and the new GDP gap, which is the red line. And you can see essentially unchanged. And what is the line of reasoning there? Well, with another consequence of the revised hours is that the historical figures of labor productivity have, of course, been revised down as well, which in turn means that we've revised our view of the trend rate of productivity growth. And we've also revised our view of trend growth during the forecasting period. And with a higher potential growth, we have lower actual growth as well. So you can see in the update that our growth figures are a bit lower than they were before. This is one explanation that we've revised. We have a new estimate of the trend growth during the forecasting period. So with both trend and actual growth a bit lower, the net is that the gap is essentially unchanged. Previously, Stefan showed you the unemployment forecast. We haven't changed our view of potential unemployment. So that gap is also unchanged. When we do our unemployment forecast, we do that looking at the historical relationship between GDP and unemployment in relation to their historical averages, their potential levels. So to sum up, we have an unemployment gap, which is largely unchanged. We have a GDP gap, which is largely unchanged. It's this graph here. And we have an hours gap, which is a little less negative. But on balance, we summarize this as saying we have essentially the same view of resource utilization in this report as we had in the previous report in February.
So then, all in all, some positive signs in the Swedish economy, but given that we have a period with continued low inflation, and the policy rate already is low as far as we can judge, the best way of doing this when it comes to monetary policy, so that we both support economic developments and make sure that we meet our inflation target eventually. We find it most reasonable to keep the policy rate at 150 for now. So this is where we are. Questions, reflections on this?
The conference has been unmuted.
Sure.
So we should interpret this as you believing that the risks are balanced in regards to your main scenario, since you keep your repo rate at 150 for a year or so.
Well, I mean, that's one way of putting it, in the sense that it's of course very, very hard to judge what happens. What happens around. Could happen around us, and it's easy to come up with very, very difficult scenarios to deal with in Europe. But at the same time, there are also brighter signs in the world, and some of them in Europe as well. Particularly if you look at not just, let's say, the Eurozone, but think about Northern Europe, and that means that this thing can go both ways, or stay exactly where we are when it comes to the repo rate path.
Going back to the productivity issue here, it seems you have changed then the potential productivity going forward slightly. In what extent is that, do you think, demand a more sensitive wage formation process in the future? It's put a challenge for the wage formation process, because with the same kind of wage increases, it might increase the cost pressure in the Swedish economy. In what extent has that also influenced the policy decision today, that you have some uncertainties going forward?
Well, in the sense that if you look at, first of all, we have a period with very low wage increases. And this time, in terms of the projection that we have made, we say, okay, wage increases will sort of roughly be within the interval, which is in some sense tolerable in the sense that nothing dramatic really comes out of monetary policy or what happens on the inflation front. But then at the same time, we have this issue, as you mentioned, about productivity, and then productivity going forward, which is not really what we have behind us, a period with very low wage increases and high productivity. And clearly, if that were to change going forward, then there is some potential for changing the cost pressures in the system. That's absolutely so. But it's too early to tell really what will come out of it. So far, there's been a lot of noise in the wage negotiations. At the end of the day, the numbers, the way we look at them, have been quite reasonable. So the end result has produced no drama from our perspective. But on the other hand, there might be a trend, if I call it that, kind of under the surface, which is a bit different compared to what we have seen in the past. And if you combine that with our projection when it comes to the exchange rate, that the exchange rate would maybe appreciate a bit, but but not very much, then that creates a potential for a different kind of cost dynamics compared to what we have had in the past.
Can I just add then that, I mean, these revisions are not huge. It's nothing dramatic. The revision is a couple of percentage points per year. So and it's an assessment we make now, and we are looking into this continually, and we'll see what kind of assessment we'll make next time.
Then I perhaps ask another question. It's more you haven't mentioned it today yet, but regarding the household credit growth. We have seen recently that the household are more positive. They also expect lower mortgage rates. Actually, it has coming down substantially in the NER survey, and we've also seen that the affordability index has improved. Is that something that might have influenced your decision today as well? That you are a little bit afraid that perhaps the slower growth we have seen in recent years in the credit growth might stop and start to increase again?
It hasn't been it's not a major issue at this particular juncture, but at the same time, this is clearly something that we follow very carefully, because if these numbers were to turn around, now they have been coming down for actually a number of, for quite a while, and looking at the increase in lending from the banks, the corporate sector numbers are higher than for the household sector, and that's, with our perspective, a very good balance. It goes sort of the right way. If there were to be a reversal there, then we would need to reflect on that. And one of the difficulties, of course, when it comes to monetary policy and projections is that here we're talking about 2 to 3 years. That's basically the time perspective. And how does one deal with other issues with a longer time perspective? And history tells us, if you look at what has happened in, by now, a fairly large number of other countries, for example, if you read the World Economic Outlook, that if you end up with a debt problem, then it's quite likely that you end up with several years of all sorts of difficulties when it comes to managing the economy. So something that one would really like to avoid, because it is quite costly, and at the same time, for now, for a decade or something like that, debt to disposable income ratio has been going up, and that means that eventually we're going to get to a point where somebody's going to have to say enough is enough, and that takes us then into more the macro-prudential territory and what is happening on that side. But with that as a kind of a background, together with the FSA, we have discussed putting in place a liquidity coverage ratio, and also a liquidity coverage ratio denominated in euros and in dollars, and that's dealing with part of this issue. And at the same time, there is an agreement between us and the Ministry of Finance and the FSA that it makes sense to increase the capital requirements. And in addition to that, we have the LTV ratio that now has been in place for a while. And if that's not really then enough, because these numbers were to continue going up, and I'm speaking for myself, it's time to start discussing amortizations in a different way compared to what we have today. And there's somewhere in that, of course, also monetary policy shows up. But then one of the technical difficulties when it comes to the model building and all the rest of it is that it's hard to incorporate a financial sector and these types of developments in these types of models. So in that sense, it's essentially more of sort of the conversation about these issues.
Have you thought about what you think is sort of like an equilibrium growth rate in credit?
No, that's one of the really difficulties, and one of the really difficult issues in this, and it's kind of similar to the debate about what is in some sense a good debt to GDP ratio when it comes to government debt. And eventually, at the end of the day, we're talking about value judgments, because I don't think you can calculate an optical number saying that, okay, if we get to that number, or if we get down to that number, whatever that number happens to be, then we have kind of, in some sense, reached a point of bliss, and that's where it should stay. So in the end, it's more crude than that. One has to pass judgment on what we like and what we do not like.
Well, then I have a final question from me. More on a European debt issue, and Spain is obviously in focus recently, and we have seen statistics recently from Bank of Spain that doubtful loans in the Spanish banking sector continues up, and is, I don't know, above 8% of the loan stock. And when looking back to the Swedish banking crisis in the beginning of the 90s, we also had similar quotas as 8% roughly in 1992. What's your view about looking, with your experience both from IMF and from the Swedish banking crisis, what's your feeling about the Spanish bank crisis?
Well, it seems to be a very kind of traditional commercial real estate housing bubble bust type of scenario, and then you end up dealing with all the things that you have to deal with. And eventually, if you try to push it into the future, reality catches up with you. This has now been going on already for several years, so it's not that surprising that we have this debate today, because if you compare to what has happened in other countries and in other parts of the world, there is probably some more homework to do. And that's why this debate is going on. On the other hand, when it comes to the technical aspects of how you actually do these things, in Spain they put the machinery in place. So the issue is more, what is the pace going to be? How long will it take to write off all these bad debts? What kind of structures will be put in place to deal with the bad loans? And eventually, how do you get all these bad loans out of the books of the banks and essentially turn them into asset management companies, or actually companies basically owning properties once you seize the collateral. So the technology is out there, and how you do these things, that's well known, but then there's some more work to be done.
Are you cautiously confident, or are you afraid that could be one factor to renew the European debt problems and make the downside scenario more likely?
It's of course very difficult to say, because by now these things have been going on for a number of years in Europe. But Spain is in some sense special, because we're talking about the banks. It's basically, my understanding is that it is confined to real estate in one way or the other, and that, in that sense, it's and given the numbers that we're talking about now, it's manageable. It's manageable. I mean, by the way, we tend to talk about kind of Europe as a whole, but if you look more closely, then countries in difficulties have their own issues, and they also have their own pace at which they deal with these issues.
Could we go back to the GDP gap?
Sure.
Could you show the picture again? You said that it was more or less the same. And going forward in your forecast, it does look more or less the same, considering the relationship between the GDP gap and unemployment gap. But if you just look at the actual data, it's more negative, given the data we've gotten so far in the picture. And I just wonder, because I saw that you revised up your Q-on-Q forecast for this quarter. So I'm just curious how you're thinking about, because you sort of stick out considering this quarter. So I'm just curious what your views are on industrial production and what we're going to see in March to obtain these values. Just sort of interested.
Okay. I'm going to ask Christina to follow here, but if we stick out or not, I don't know. I mean, it happens to be that for this year there's a large consensus regarding the average growth during this year. I mean, both the government, the National Institute, but you're looking very much at the first quarter. Okay, but I think if Christina could fill in on that.
We have a lot of indicators, of course, for the first quarter, and we have like retail trade and exports and industrial production and service production and all these indicators from the National Institute as well. And when we look at all these together and put them into all our different kind of macros models that we have, we actually get a higher forecast for the first quarter than we had put into these figures. So we're keeping a little bit lower than our models. So we think that we will have a catch up from this very low level that we saw in the end of last year. So, but of course, I mean,
and then you have a revised GDP gap for such a short period of time, so it doesn't affect your unemployment. Is that the interpretation?
The unemployment forecast.
Yeah.
Yeah. Mm. Okay. So our view of the business cycle on the gap or resource utilization are almost the same as before, despite all these revisions we have in the data.
This is one of the few times when you actually add up the numbers, things didn't change that much. just happens to be that way, because usually the arguments are the other way around, that things have moved around so much, so something has happened. But this time it just happens to be this way, at least in order to our according to our judgment. Right or wrong, time will tell. Okay, any more questions? Those who are listening in over the phone? Well, if not, there is total silence in the room, then I take it that it is crystal clear. Thank you for coming, and thank you for many good questions. This is where we are, and if you have more questions and more reflections when you get back home, you know where we are. Thanks.